Alrighty, folks. Yes, she is back. The one and only Anna Kelly. We've been talking every week for 5+ years now, and given our travel schedules, we haven't actually spoken in over 6 weeks. So, yes, she is back. No, she didn't decide to leave us. We were just having busy travel plans. How you doing, Anna?
I am great. No, I don't plan to leave you as long as you stick with me. So we have a lot of fun together, and hopefully the audience enjoys it. But it does feel like a minute. And what craziness has happened since we last talked? It just gets curiouser and curiouser, to quote Alice in Wonderland, I think.
Yeah, no, I mean, there's so much going on that I've been reading. I'm like, I got to ask Anna. I got to ask Anna. I think the big thing that's jumping out to me among everything that's happening is your call about stagflation, which I think started a year ago, might even be 18 months ago,
Yeah.
is certainly becoming more and more and more possible. I mean, we are staring at the real possibility of seeing stagflation in 2025. So that's the first thing that jumped out at me. What about you?
Yeah, it's a hard word to use because it's got a lot of emotion to it, right? And it's really hard for countries to get out of true stagflation, right? I think we've been in this kind of stagflation-like environment for a while, where you just, it's constantly, it seems like inflation's coming down, and then oops, it starts to go back up, and it seems like employment numbers are starting to go up, and then they tip down a little bit. The same with GDP. It's kind of been just this drag with a slight downward pull, right? And I've been saying for longer than I wish to admit, but I think the data has been very warning of recession since 2022. I mean, we had the 2 quarters of negative GDP. So I've seen very clearly the deterioration of the economy, although very slowly. And like we've talked, until you get past it, you don't really know what it is. But we've seen this stagflation, where you've still got inflation while you've got declining growth. And basically stagflation, it sounds like a scary term, but it just means that you've got kind of a stagnating economy. You've got slowing growth, and you've got more inflation than you'd like to see. I mean, just to kind of dummy down what it means. So that slow growth path has been deteriorating since 2022, with just blips of where it seems like, oh, maybe we made it. Almost like rolling recessions. We've used that term as well, because we've seen housing going into recession in terms of transactions. We've seen that manufacturing going into recession, came out a little bit at the end of last year, has gone right back into it. We just didn't really start to see the profit declines, which tends to happen next. If you follow Michael Kantrowitz's model of hope, you have recessions follow a trend of housing, then orders of manufacturing, then profit squeezes, and then that unemployment. And so that's been a very slow decline. In fact, it's taking, to give myself a little bit of credit, which I don't try to do too often, but although my call appears to be 2 years too early, right? That, hey, it's recession-like conditions. What it shows is, if you look at the leading economic indicators, and that's what I like to track more than the real-time numbers, is where do these leading economic indicators that the Conference Board and the National Bureau of Economic Research that dates recessions, where are they headed? And they've been in a decline, the longest decline since the composite turned negative that we've ever had. Over 25 months, they've been declining, yet the headline broad numbers have been okay. So that part hasn't surprised me, that we're starting to really see what seems like expediency in a quick decline of more of the real-time coincident numbers. But the inflation part is just, it's sticky. And history tells us that a lot of times it's not once and done. Sometimes you have these double peaks of inflation where it looks like it's coming down and then it rears its ugly head. And we've had a lot of those fears. But what's really shocked me, nothing really shocks me, but then, it's like, oh, here's another shock. We're kind of in this era of lots of surprises. And, I think that we all should have been preparing that if Trump says what he's going to do, which he said in the campaign trail of raising tariffs, it could cause inflation to come back up along with this decline. So the stagflation-like environment doesn't surprise me at all. But what did shock me, Michael, was the way he calculated the retaliatory tariffs. It was done in a very interesting way. I do not claim to be a tariff expert. I am absolutely not. But I listened to a lot of people that thought they knew what it was going to do, and he did something totally different. So I think what we're seeing is this shock and awe that not only did we just come in and say, whatever you tax us, we're going to tax you, which is what we all thought reciprocal was going to be. But it's the way he calculated it based on trade imbalances that has the markets absolutely freaked out. The bond market, the stock market. And the question everyone has is, how inflationary are these going to be? Is it just Trump's way of, I'm going to bully, I'm going to start hard, and I'm going to force you to negotiate? Or is some of this intended to stay? And if it does, how inflationary is it? And I think it's more stagflationary than it is inflationary because of it hitting at the time of all this declining growth that we just talked about, but also the fact that I think the consumer is pulled back and crying uncle. And the fact that 50% of the GDP, the consumer spending, was done by the top 10 income earners, and now they're seeing their portfolios roiled and pulled down. I think that top 10% starts to pull back on fear, that we're finally kind of getting to that point of fear that's just, not been the maximum point of fear that you usually have in a recession. But I think that consumers are going to go, I'm not going to take those price increases. So the companies are going to have to absorb them. And that's going to keep, I think, inflation from being the problem. I think it's going to be some inflation that ticks up in certain areas, especially where the tariffs are hard, like steel, for example. And then you've got this declining growth. And I think from what I'm hearing, Scott Bessent just gave an interview. He said these are going to take through 2025 and 2026 to negotiate. So that tells me we got probably 2 more years before the dust settles and we know where tariffs are really going to be. And that means fear, declining growth, and some inflation and uncertainty. I think we're at kind of as close as stagflation as what we've seen since I was a wee little girl and don't remember, in the 70s, early 80s.
Yeah, there's so much there I want to talk about. Let's first go to the recession call that, frankly, both of you and I made, right? I made two. Yeah, I made 2 recession calls, was wrong both times. But I spent a lot of time.
You weren't wrong. You were early.
It's okay. I don't mind being wrong. I learned. But, I've actually spent a lot of reading on this the last 6 weeks. Again, I did a trip in Asia where I did a lot more reading and just calm reflection. And the thing that I got wrong or didn't calculate, because it never happened before in my 30 years of studying the economy, was that government spending went 3 to 3.5% above trend.
Yes.
Right. And that's hard for an outside guy who's not used to, the government numbers. And frankly, that's the only reason both our recession calls were wrong, is because government spending, unbeknownst to us, was at, I don't know what it was, 8.5, 8.7%, when it's usually at 5.5, whatever that is. And that hit a lot of problems.
Exactly.
So,
and those numbers were not announced. And so, it really was a hidden thing. And it in some ways, it doesn't surprise us, because we know 2 things. One, the more recessionary conditions become in more recent history, more modern history, the more governments try to do, both from monetary policy and fiscal policy, to keep it from being a really bad recession and a really hard landing. And so they pull out all the stops. And so, it has happened historically, regardless of who's in office, whether it be Republican or Democrat. It's very bipartisan, right? To be fair of what happened. However, it was not announced. It was very quiet. And so, I did pick up on some of these data points where I was really nervous at the beginning of 2024, that the data did come out and show that all this hiring and this, big employment number was primarily government spending and healthcare. And anytime you have more than 10% of the growth in employment be government spending, it has been a very strong indicator that you're basically in private sector recession and the government is spending. So it has happened in the past, but their normal number has been, we'll spend up to about 10% of employment. And what they did is they spent 25%. They spent enough money into GDP and hiring to where 25% of all the new jobs was government spending. So that was the first sign that I was like, whoa, this is why the SOM rule didn't say we are in recession. we were in a private sector recession. We just are not in a broad recession. And I think that's what's really important for people to understand is, we can nitpick recession calls. Are we not in it? But when about 68 to 70% of GDP of the nation is consumer spending, and that's non-government spending, and that starts to decline as much as it has, the government can spend all the money they want to keep that total aggregate number slightly positive, but it doesn't give us a true reflection. GDP headline numbers don't give you a true reflection of where is the private sector. And the private sector clearly has been in recession in and out, but very close, negative pullbacks by and large for almost 2 years. It's just that now the top end's starting to pull back. So what really concerns me, and to your point, we didn't see that coming, right? But what really was interesting is just how long the consumer continued to spend despite their wages slightly falling. The number of hours worked were falling. So many were taking on second jobs. And that's the other big piece that surprised me, because I wasn't really watching that number, but the gig economy and the number of people taking 2 to 3 part-time jobs reflected in, they're working, less people filing unemployment, but still struggling. And that is something we haven't seen. The prior major recession in 2008, we didn't have Uber and Uber Eats and all of these other gig jobs and remote part-time jobs. And so that was a big surprise to me. And it kept people spending, even though they're living check to check and they're racking up credit card debt. The consumer wasn't afraid enough to stop spending. And so the spending between the consumer on credit and the government together kept us from having 2 more quarters of negative GDP post 2022.
Yeah. And the data is really, showing that. I think it was Scott Bessent that really said that the private sector has been in a recession for, quite a while now, which I agree with. So if I fast forward in all of my topics to review with you, the other one I'm thinking about is, how can't we be in a recession now? And if I think about the U.S. economy very simplistically, there are 3 legs to the stool. The first one we already talked about is government. And I think it's very reasonable to say that government spending will be going down compared to previous years. I don't think that should shock anyone, right?
At least for now.
Yeah, at least for now, right?
Yes.
But the promise of Doge is less government spending. Okay, great.
Yes.
Number 2 is they call it private enterprise. Think small and big businesses, right?
Yes.
Is the next leg of the stool. Bigger than government, but smaller than consumers. I can't imagine being an executive or an owner of a small business right now with all of this chaos going on. Like, are you going to be Micron, which today announced a surcharge for tariffs, so they don't have to change price. They'll just drop the surcharge if tariffs go away. Could you be a small business and do some capital investing? I mean, there's just so many businesses that I talk to and people at VP levels and above, they're like, dude, we don't know what to do. We're going to stand pat for 30, 60, 90 days and see where the chips fall. So again, that feels very contractionary. And then
just a point on that, Michael, I was just listening to an interview with Dana Samuelson with American Gold Exchange and Danielle DiMartino Booth. I think they recorded Friday or yesterday. I just started listening to it and I haven't finished, but she tracks a lot of data. And that was one of her more recent data points that I haven't heard her talk about. But as I mentioned in that HOPE framework, we're kind of the next to the last shoe to drop is that profits are missed. Yep. CEOs had a lot of excitement in the election because they thought, okay, pro-business is back. We're going to have corporate tax cuts. And they actually really upped their projections for CapEx, for spending money to invest in their business. And although right before the election, CEO surveys had said they expect layoffs in 2025, once they were interviewed in December of 2024 after the election, they expected fewer layoffs and more investment. Now, the most recent surveys of CEOs, they've come back and say they are negative as to the impact on tariff on their business and the uncertainty. They're revising their earnings projections downward, which is that P in profits in that framework. And they expect to have to significantly, moderately to significantly reduce headcount. And I had read a survey about a week ago, I believe, that said 30% of CEOs expect layoffs this year. So you didn't see that. It's like a stark reversal. And so although the economy was already struggling and the threat of potential tariffs making some dent in inflation was there, the way that tariffs have been rolled out has definitely spooked. It's added another layer of uncertainty to the business world to say, where are things going to go? And can we actually pass those additional costs on to the consumer? And right now, CEOs are uncertain that they can. And I think rightfully so.
Yeah. So again, we have the first two legs of the stool going the wrong way, AKA contractionary. And then of course the consumer is going to contract as well. Again, one thing both of us have studied the economy and consumers for 3+ decades. The consumer is remarkably easy to predict. When the headlines are this chaotic, they're just going to sit on their wallet. They're not going to buy homes. They're not going to do this. They're not going to do that. So we really have all three legs of the stool going the wrong direction. I just don't know how that doesn't end in a negative GDP print, probably Q2, because I think Q1 will have a little Q1 end of quarter bump because of the tariffs, right? A lot of people bought cars and things of that nature pre-tariff. So I don't know how Q2 is not negative.
Yeah, and even even the conference board and some of the bigger houses that make money on investing, right? Like Goldman Sachs, for example. I think Goldman was one that came out and said, we think that there's going to be a negative GDP print for the quarter. And so when the big investment houses that have kind of been like, hey, I think we're going to float along okay, or going, wait a second, not only are the official GDP expectations being revised down from at the start of the year, it was like 2.7% for the first quarter. Then it dropped down to like 1 point something percent. Now they're expecting potentially negative. So depending on how March played out, we could have a first quarter negative. I'm not sure if we will, but I think second quarter, to your point, we're already rapidly seeing it. And a lot of people don't see it because it's not necessarily big companies, but we do have the most layoffs right now, a lot of them in smaller to medium-sized businesses, but also the largest number of layoffs that we've seen since 2009, which was the great financial crisis. And so, you've got to see the fact, and I know multiple people personally who've been laid off. I'm starting to see industrial businesses and manufacturing in my area that have been really resilient. We're cutting 600 people, we're cutting 1,000 people. So you're starting to really see an uptick in that. And as people are laid off and they're seeing the headlines start to actually show those layoffs, as that happens, they're becoming more fearful. I know people, all over that are like, now I'm afraid to lose my job. And so that leg, Michael, doesn't normally happen until the very end. It's the last shoe to drop. And so, when companies start to lay off, it takes that before consumers really start to pull back. And another interesting data point that I haven't fact checked Danielle DiMartino Booth on this, but it was on the same podcast I just mentioned. And she's amazing with the data that she tracks. I mean, probably one of the best I've seen, although she's been very early, warning of recession as well. But what she showed was that when it comes to the consumer spending, that the last 3 major recessions, consumer spending actually continued through the recession. It was not until the recession was declared and employment started to rise that consumers pulled back. So that surprised me. I hadn't drilled down that deeply into how far did consumer spending go. Now, it is historically relevant that about 50% of the consumer spending has been floated by the top 10%. Usually the lower end consumers still spend more until then, but the fact that it has been the top 10%, I think the fear factor, to your point, is much higher today than what we may have seen before until after unemployment rises. And so, I think consumers continue to pull back, especially that top 10%. They're going, now that my wealth, what was it, $8 trillion of wealth, paper wealth wiped out of the stock market in 2 days, gone. That has a psychological impact even on people with money. to go, I'm going to start pulling back. Let's see how these tariff things, happen. So I believe, like you, that we will have a negative GDP print in second quarter and that recession is here. And, let's just hope that the inflation monster's tamed fairly quickly, because it's a lot easier to bounce back from a recession, Michael, than it is for the government to get us out of stagflation. And Jerome Powell's hands are tied.
Oh, yeah.
He's in a tough spot that isn't going to be easy. And, time will tell, what thing manifests sooner and how that impacts rates.
Yeah, we'll get to stagflation and Jerome Powell in a minute. The last thing I wanted to say about the consumer is exactly what you brought up, that top 10%. And if people wanted to research something, you could look at something they call the wealth effect. Mm-hmm. And really what we've seen the last couple of years with the top 10% being 50% of consumption was the wealth effect on steroids. These folks' assets went up. Inflation's a feature, not a bug. They've been feeling really, really good until the last 3 business days. In the last 3 business days, the top, I got this stat from All In Podcast, I think. Or no, it was Scott Besson. I take that back. Scott Besson said the top, I want to make sure I'm right. The top, what did he say? I think he said the top 12% of Americans own 88% of the market. And then the remaining 38% own the others, and the bottom 50% have debt. Those numbers might be off, but they're close. And when you own, the top 12% or 10% in this example own 88%, and they just saw a 20% drawdown, in some case 30, 35%, that's going to have an impact, at least in the moment, right? It may not be long lasting,
right?
But you're going to go, oh God, I just lost, I don't know what it is, a big number in my net worth. You're going to take a pause, and you may not take that cruise. You may not do that European vacation. You may not buy that second home. You're going to pause spending because you just don't know how bad it's going to get. So everything's going backwards as far as GDP in the U.S. economy.
Absolutely.
Near as I can tell.
Yeah. And that wealth effect, it's the top 10%. What makes me a bit nervous, and I talked about this, maybe on the show before last that we did a couple of months ago, that I felt like the S&P was going to have a pretty decent size correction.
Yeah.
It's because of these things, and the fact that our assets are so heavily weighted, liquid assets, financial assets are so heavily weighted in the stock market right now. And so, not just the top 10%, which is a big piece of that, but there is more money in ETFs, exchange traded funds, by retirees and workers, that are in their 401k, and they're in these ETFs that are very heavily weighted in themselves in those Mag 7s, and in a lot of companies that the price to earnings ratio is just crazy, and so when there is a drawdown, and we haven't seen the impact yet in the stats of, what happened in the last couple of days, but when there is a drawdown, not only does it impact that top 10%, but most people who have 401ks, when their ETFs go down, a lot of the retirees who have a substantial amount of the money in those 401ks, in those IRAs, in those ETFs, they don't have time for them to bounce back. Nope. And that creates a lot more fear. And if we start to see that those who are nearing retire age, which are the boomers, which have spent a lot of money, a big piece of the GDP, I just can't remember the percentage off the top of my head, but they're still spending a lot more than younger people. Those older boomers who have the money, who are paying for the vacations for their kids and grandkids, their retirement accounts, suddenly it's not like 2008 when they're like, well, I guess I got to work a few more years. It's this money that's wiped out is gone. And if they start to pull money out of the markets, that's going to cause more selling and more fear. And it could be a pretty deep spiral, maybe a deeper correction than what we're expecting. So we got to watch that.
Yeah. And then, the next thing that's coming up, and it starts Wednesday, I think, with Delta, but really gets going on Friday with the big banks, is earnings seasons.
Yeah.
And we're already seeing more and more financial analysts take down their targets for the S&P 500. But again, I've lived this story before, right?
Yes,
you're right. Right now, executives and companies are looking at their past quarter, and they're making plans for the future quarter. And one of the things that I don't know if people realize is, if you're an executive and you announce a weak quarter coming up while everybody else is meeting or raising, you look like an oddball
Mhm.
and you risk your job, frankly. However, if you're in an environment where everybody is lowering expectations, you get a pass.
Yeah.
So guess what's going to happen to earnings expectations the next 3 or 4 weeks? I cannot imagine any executive going in and saying we beat and raised guidance. That
Yeah.
is not going to be this cycle. I don't
Mm-mm.
care if you're an AI person, a bank, an airlines, every executive
Yeah.
is going to go into this going, we're going to take down guidance a little. And
Right.
some will take down guidance a lot.
Yes. They
So
have
that
to, Michael,
they have
because
to.
the earnings expectations have been, priced to perfection, as
Yeah.
they say.
Robust.
Meaning everything has to go right, right? We've averted a recession. It's a soft landing. The consumer is strong. They're going to keep spending. We're going to keep making, our products or services, and it's going to be gangbusters like no tomorrow. They have priced in over the last year or two, and so have investors who've continued to buy and prop up the value of these stocks. They've priced in it has to be a soft landing, and with Trump at the helm, taxes are better. We're reshoring some stuff, but without
deregulation,
all of that stuff. And they just expected that we're on the way to the next expansion. And so they're finally having this proverbial come to Jesus moment going, wait a second, we're wrong both on the strength of the consumer. We're wrong on whether we might have a recession. We're wrong on how bad inflation might be. And I think that those corrections could be big. And to your point, the question is, how long does it take them to announce them? But when they do, and when those earnings expectations are revised downward, that's going to create another level of fear for all the stockholders. And they're going to be like, I better cut my losses, especially because they don't know how bad are the tariffs going to be. And the other thing that I don't think is getting enough headline, right? We're very America focused, as is normal, but what this does to the other countries, that this will quickly put other countries who are already, some of which are already in recession, into a deep recession, because suddenly America's saying, we're not buying your stuff. They rely on us as the person to purchase that. When the global economy goes into recession, even if the American recession is somewhat light, comparatively, it makes a big difference in international companies. And most companies now, Michael, are international companies. And so I think we have to recognize that now they've got to not only take into account maybe a realization that we might be in recession, but that if these tariffs take 2 years to shake out, as Besant said they might, that any of the people who are buying their goods and services, and all of the, in addition to the inputs of what they're producing, might significantly come down. That gross number, not only is their net profit margin being squeezed, but what's that gross number going to be if we're in a global recession, which very well could materialize here pretty quickly. So I think it could be worse than people expect. And again, I'm not a doomer. I'm really not. But I've learned that when we're dealing with uncertainty and markets, this is kind of that point when you think, I'm not yet at the maximum point of fear that creates panic. You realize that you're on that trajectory. You don't know how bad it will or won't be, but you better be preparing yourself. You better move into asset preservation mode and protect what you have, and prepare for what is the worst thing that could happen. How do I mitigate my finances in case that does happen? And then I'll be pleasantly surprised if it doesn't. And as you start to see the panic, then okay, I'm not going to panic. This is like the ultimate opportunity to buy and go in when everyone else is running away and afraid. But you only do that with what you can afford to come down a little bit, what you can afford to lose, and what you can afford to hold longer term. So I'm somewhat excited, Michael. I didn't panic the last couple days. Number one, because I didn't have much in the market. I took my gains and I pulled a lot of it out, other than a few stocks for the long term. But I actually went in and bought some stocks in the last several days. I did earlier this year too. Unfortunately, I bought Tesla right before everybody started burning Teslas to the ground. So, I came down a little bit, but you have to look at What I think we have to do is be brave and be excited that finally a lot of the fluff is being washed out. We're starting to see where things really are. And for those that are prepared, we really might see an incredible opportunity to buy assets. We're talking about the stock market right now, but real estate, you know, all assets have been in a bubble, and all assets will have somewhat of a pop in that bubble. Real estate per se, which I know we want to get into, is very regional, and there's a lot of different asset classes in real estate that are doing well or not doing well. But we're getting close to, I think, the fear gauge that's needed to have the washout and to have the maximum point of opportunity as investors to run in when everything's on sale. And so that's exciting for me because I've been prepared, right? Same with you. And we've been trying to prepare other people so that you're not freaked out right now, but you're going, okay, things are kind of hedging, you know, heading this way. I've kind of been prepared. Now, what do I go in and where's the opportunity to you know?
It's funny you bring this up because it's really comforting to have a foundation of real estate, which you can't liquidate quickly. Right. Which is pretty awesome, which we can talk about later. But it's funny. I actually moved into stocks as well. It's funny. I actually bought Tesla the day, or I guess the morning after Timmy Waltz started showing off his phone. So I picked up Tesla at like 234 because I was just pissed off. I was emotional. And then I actually bought some Nike after that Vietnam 48% tariff, which is complete Fugazi math. Like, I don't know where the hell this math comes from. This is not a tariff. This is a trade imbalance. I mean, at least call it the right thing.
Right.
But most importantly is I moved a pile of cash into my account so that I could go shopping as we go down. So it's funny. We were thinking the same things. It's pretty crazy. But now let's talk about the headline of the video, stagflation. I am willing to put on record that June and July of this year is going to be Jerome Powell's most important Fed meetings. Why do I think that? If you step back and you understand the raw material, we have something called the base effect. And it's funny we're talking today because tomorrow we get CPI, and CPI is supposed to, again, the experts are saying, look really good. What does really good mean? It was 2.8. It is expected to fall to 2.5. That's a big drop in the headline number for a single month. So I will, again, if they're right, you're going to hear everybody and their brother start clamoring for the Fed to cut rates because, again, you've won the battle. It's falling and falling quickly. However, the base effect essentially is zero for the next 3 months, heading into the teeth of tariff impact.
Yes.
And on the flip side, we are heading into more and more weakening job market, unemployment, things of that nature.
Yeah.
So it's either June or it's going to be July. Jerome Powell is going to have to pick something. Is he going to pick Paul Volcker and fight inflation? And I don't know if you heard this, but Larry Fink yesterday, Larry Fink said there's a chance the Fed has to raise rates in 25. The market expects 4 cuts.
Yeah.
Larry Fink's like the chances of getting 4 cuts are 0. That's what Larry said. So again, the chances are rates could go up. I don't think they're going up. I think they stay flat, as I've said all year. But we're going to have a problem. We're going to have a clearly weakening economy. Q2 is going to be ugly.
Yes.
Unemployment is going to be higher. And inflation is going to be up.
Yeah.
A la stagflation. Ugly, ugly, ugly. What does Jerome Powell do, you think?
Yeah, you know, it's kind of back to the beginning. Like, I think we were early on our call, not seeing, you know, some of the things we hadn't seen yet and seeing that materialize. I've learned that my crystal ball on timing is off. You know, these are long and variable lags with a lot of complexity that can change how it's happened in the past, right? The things that are different this time. I will say this. I agree with you. I think he's in a very difficult spot because we are in a stagflation-like environment. I do track Trueflation, and Trueflation has been kind of up and down, but it's been goods inflation has clearly been coming down. It's more the services side of the economy that has had inflation. And a lot of that's been healthcare, auto insurance, homeowners insurance, and also travel by that top 10% booking travel. And so restaurants have been kind of, starting to come down. But generally speaking, Trueflation had an under 2 handle, and they look at a lot more goods and services than the headline CPI and PCE and all of that. It ticked back up after the last quarter and January, but it's come back down under a 2 handle again. I think it's around 1.6, 1.7, but I haven't looked at it the last couple of days. But what it's showing us is that both goods and services are starting to come down now. So outside of tariffs, I would say the greater risk is still recession and increased unemployment and profits misses than inflation is in terms of the things that the Fed can control with interest rates. Okay. However, the big question is, what does tariffs do to that number? And I think initially companies are going to try to pass through any input costs on things that we know are highly impacted, like drugs, to the extent that they can, because we get so much of the components from China. Something like 70 to 80% of what we put into drugs comes from China. And then also steel. So things like cars, things like housing, renovations, etc. So the question is, do the consumers already say, I'm not buying, and they starkly drop off spending? And then that will keep inflation from getting too high. Or are consumers and businesses going to take it for a little bit, pay those higher prices for a few months, so that profits misses aren't as bad? I think there might be just enough fear this time, Michael, based on what we've seen in the stock market the last couple of days, that the consumer says, I'm not buying. I'm just going to hold tight. I'm not going to, take the increase. And therefore, even though the fear is that these tariffs spark mass inflation, that it actually becomes deflationary because the consumer says, I'm not going to bite. Therefore, companies have to just reduce their profit margins and eventually reduce their earnings. So it's hard for me to say for sure, but I would bet just the trajectory and the speed of recessionary type conditions, I would think that he ends up with seeing more layoffs between now and June, less consumer spending, and that actual real-time inflation number continues to come down, but that he is still very worried about, is this going to be very inflationary in the coming months if things do not materialize? And so if he's stuck in that battle, I think the number one thing he's looking at is where is the unemployment and how fast are these job layoffs? Because he wants to get ahead of that. He wants to get ahead of recession. The recessionary conditions broadly haven't been bad enough yet for him to say that risk is greater than inflation. If I had to guess, I would say by June or July, we have more fear. I think that unemployment number might tick up to that 4.3 handle. And, I would say by September, the next cut, I think materially the economy will weaken, will be in recession. And by September, he will have to cut rates, even in the fears of what these tariffs could do to inflation. I don't know if he'll hold the line in June. I expect he'll have a rate cut in June or July, not material. I think it's like we have some weakening. We're going to cut a little bit. And I think the reason he can do that, Michael, where he couldn't do it before, is because now he sees that there isn't going to be this irrational exuberance. And as soon as he cuts rates, the markets are going to rally, which is animal
spirits.
The animal spirits. The fear has been, if he cuts another 50 basis points, people will go spend, companies will go spend, market, and then you have the wealth effect again. And then that is a threat to inflation. Now he's saying, the markets are getting nervous. We're not going to have this rebound when I cut rates because there's enough fear and uncertainty in the other things that he's not going to be as worried about that, in my opinion. So I think that's why he could cut in June. I am going to go against what Fink says. I think that the economy is going to weaken materially pretty quickly. And I think we very well could see 4 cuts this year. I just think they're in the later part of the year, maybe September, into December, as things start to rapidly, materialize into recessionary conditions. That would be my guess.
Yeah, so I just pulled up Trueflation. It's actually down to 1.4,
Yeah,
1.4
which is a
as
big
of
dip.
right now. Oh
It's
no,
about a
no.
percent difference from, I think, January
Yeah,
or
January
February.
was as high as 3.
Yeah,
I have the
close.
chart up. Yeah, so
Awesome.
you're absolutely right. So, when I look at what's coming, it is certainly going to have the recipe for all out stagflation. Again,
Yep.
stagflation doesn't have to be a negative print. It just has to be below trend. So if we post a number, which some people are calling Q1 GDP to be 0.3, that is clearly in the stagflation camp, just so we're
Yep.
clear. Doesn't have to be
Mhm.
negative. And inflation again last month went up. It went from 2.6 to 2.8 or whatnot. So again, we certainly have kindling for inflation. I'm
Yeah.
going to take the other side with you,
Mhm.
which I love disagreement. I
Yeah.
think Jerome Powell has been remarkably clear, unlike Yellen, unlike Bernanke, unlike Greenspan. I think you can take Jerome Powell at his word.
Yes.
And I believe he has been very clear that his number one concern is inflation.
Yeah.
So if he's sitting in June and he still thinks we have additional ripples coming through with tariffs, which, oh, by the way, could get worse, right? China just said
Absolutely.
they're going to slap a 50 on us. And then
Yeah.
Trump said he's going to go 50 back, right? And oh, by the way, China makes up 1/3 of our
Yeah.
trading
That's our
discrepancy.
big unknown. We just have no idea whether this is sparking a true trade war and
Exactly.
how ugly that could get. And so it's a very big, to your point, it is a very big fear of Powell's that he's got to watch. And so, I agree with you there. I do. I mean, I think he's more worried about it until we see what happens and how countries react than
Yep.
maybe the markets are.
Yeah, and again, as Scott Bessent said this morning, right, these are months, if not years, of negotiation. So we're not going to see a Rose Garden ceremony tomorrow with Israel doing this, and then the next day Japan, and the next day South Korea. We would all love that, but it sounds like that's not coming
Yeah.
anytime soon. So again, I think Jerome Powell in June is looking at the threat of still upcoming inflation. I believe even by June, the unemployment rate will be higher, but it will be below 0.8, which
Yeah.
again is full employment, right?
Yeah.
5% is full employment, right? Let's not lose sight of that. 4.8 is worse than 4.2. I get it. It's still
Right.
full employment. So I think Jerome Powell is going to sit at this in June and go, him and Ha and the hard data, the soft data. But I cannot see him cutting with unemployment below full employment. Now, if for some reason it goes to 5.1 by June, he's cutting, and it might be an emergency rate cut. If the elevator goes up that fast on
Right.
unemployment, damn their torpedoes. I
Yeah,
just don't see
absolutely.
that. Yeah.
Absolutely. And that's where, the timing is just hard to predict. How panicked are companies and how quickly are they going to lay off? That's
Yep.
really what it comes down to. And, I don't remember, I just can't remember, but I think when it was, but there was a press conference early on where he said, 4.2 is really not that concerning to
Yep.
us.
Yep.
But the rate of change was. And I thought that either he or one of the other voting members of the FOMC said that 4.3% would be a number that they're watching. So
Sure.
4.3% was a concerning number to them at some point. And we weren't there, but we were at like 4.27, I think, before. So
Yeah.
we're close to that 4.3. So I've been watching that 4.3 number because, again, one of the things that's different this time, that was another thing that kind of surprised me because I didn't realize just how big of an impact it was the amount of migration and the amount of workers that we had. That
Yep.
was not taken into account in those unemployment numbers. And so when you look at unemployment for those who were here that didn't just come in the last 2 years,
Yep.
whatever you want to call them, that number actually is up quite a bit higher than that 4.3 number. And
Sure.
so typically they have watched very careful the SOM rule, which is what's concerning is more the rate of change of unemployment than it is the ultimate number. So, I just don't know at what number does he say it's concerning enough that when unemployment's usually a lagging indicator, it's like real time. If
Yep.
it starts to tick up before you're in recession, that's a sign that the recession could be worse worse than what they're expecting. So I think he is looking kind of in real time to go
Sure.
and he's just got to balance these risks. And so, but yes, to your point, and even about stagflation, he's got to think short term and long term. In the short term, I think recession is a real risk that's starting to materialize more rapidly in the last couple months than it did before.
Agreed.
And in the short term, tariffs could be much worse than they are. Maybe Trump wins, wins in that countries come to the table to negotiate, and ultimately we have lower tariffs. But I think the other thing that this conversation hasn't really brought up is the U.S. debt. And Powell is looking at the fact that in the long term, unless we get that debt down, and right now it's kind of Trump's plan is like bending the curve, but it's still growing the deficit for a while until it starts to bend it and eventually get deficit spending to like be at 3% per year. But I think Powell understands and knows that we've got to deal with the short term right now, but we've also got to look at the long term. And the long term is still a higher inflationary picture than what even though inflation's coming down, trueflation's coming down for the short term. In the longer term, we have real risk of lower GDP, declining growth, declining birth rates, declining people. We're going back in that deflationary path that we've been secularly over the long term, and we have higher risk of inflation. So even if stagflation is short-lived in the short term, I think Powell knows that over the next decade or so, stagflation is more of a risk than the temporary recession that will eventually manifest. We will be able to recover out of it. But I think this recovery is going to take a lot longer, and that we could have a real flat decade. I've been saying that for a while.
Yeah.
Flat decade just means it's stagnating. It's low growth, higher inflation. And I think that that's a concern over the longer term, that Powell's got to weigh that and say, if I react this way to the short-term pressure, how will that impact the longer term pressure of stagflation? And there's no good answer. It's a hard thing to get out of. So I don't think we're so much on a different page. It's just the question is, how bad does the how bad does the market fall? How high does unemployment get, and how rapidly does it happen, compared to how quickly do the prices increase based on the tariff threats. And then if we have a recession, maybe this is a conversation for next week, but if we have that recession and it's bad, how much money does Congress print to get us out of it? And guess what that does? That creates more inflation pressure. So it's like, it does create kind of this doom loop with pressures of inflation and low growth, neither of them going away, even if we have a recession for quite some time. So that could mean that Fink is right and that you're right. And despite economic pain, he has been very clear that he wants to get rid of the Fed put. And so he's going to hold as long as he can until he can't. He's got a hard job ahead of him.
Yeah, he's going to go as long as he can, and maybe even go 1 month farther. But eventually the economy and the unemployment will force his hand. That I agree with. The last thing we'll kind of close on, and this is really the point of this video, I believe, and we're going to see if you do as well, the Fed would much rather have a recession than have stagflation. True statement?
100% agree with you. I shouldn't say easy, right? It's fairly easy with the tools that the Fed has and that the Congress has to get you out of recession. Not saying it's the right tools, but they will print money and keep rates low because it will stimulate growth, and eventually it will get people to stop being afraid and to go back and start spending, borrowing, investing in the economy. So the tools are there to do that. When you have inflation and inflation alone, it's fairly easy to eventually get you out of it. You raise rates, you pull back money out of the system, and eventually it happens. But when you have those dueling factors, both being at risk, the tools to one make the other worse. And that's why the Fed's hands are tied. They can't really cut rates too soon because it sparks more inflation. They can't cut them too late because then it puts you into a deeper recession. And so they are dealing with both of those things, and their tools are not enough to kick one over the other. And therefore then they have, and then they're at the whim of what Congress does with monetary policy. The more money Congress prints,
Yep.
The faster they're out of a recession, kind of, but then the more they put you into the next asset bubble, inflationary cycle, and his hands are tied. So recession is a cure for high inflation, and recession is needed, in my opinion, to wipe out, the excess. And I hope that that's the case rather than long-term stagflation, although that's not my prediction. I think we have the recession, we have some stagflation, and we need to be prepared to say, even if it's a low growth environment, even if costs are up, where can I make income? Where can I put money to invest for growth? And how can I preserve what I've got? And so you have to have that mindset in any cycle, but I think especially now, recognizing that the pain isn't over and we're not going to have this mass expansion and this productivity miracle that's going to make things instantly better in a year. It's just not going to happen.
Anna, where can people find you?
You can find me on your show, on my channel, on my playlist on your channel. Most weeks, you can find me on social media at Anna Kelly REI Mom on my page. And you can find me at Anna Kelly Investing for Real Estate Coaching and Consulting.
Thank you so much. Have a great week.
You too.